Hey, good morning once again, options traders. Well, this question comes to us from one of the traders in our very group here asking a very good question. What is a short squeeze? Now, these come up all the time in the markets. Probably the most well-known is with GameStop not too long ago, just after COVID, which many of you remember, volatility shot up at like 650%. So they're an interesting type of phenomenon, and they can make incredibly good trading opportunities, but they can also be very dangerous. So let's go take a closer look. What is a short squeeze and how do you play it? As always, before we do, please be sure to click like and subscribe. Helps a lot to promote the channel and is always greatly appreciated. So let's start off with the definition. What is a short sale? This is what sets up the short squeeze. We have a lot of people that are out there shorting shares of stock. And to do a short sale, you borrow shares from the broker. Now that might sound like a complicated process. Brokers are set up to do this. You just click on sell, assuming you've got the margin requirement, and you'll be short the shares. You can short shares just as easily and quickly as you can to buy them. Again, that's assuming you have the margin requirement, which we'll talk about in a moment. Now, when you short these shares, the catch is that you owe the same number of shares back to the broker. You do not owe the same dollar amount. Otherwise, it wouldn't work. So if you borrow 100 shares of stock, you owe 100 shares of stock. And when you do this, the short sale, you are trying to profit from falling prices. That's why speculators will short shares. Now, notice that the short sellers are doing the same thing as buyers, just in the reverse order. So short sellers are buying low and selling high, just in the reverse order. They're starting out by selling at what they think is a relatively high price and hoping to buy it back cheaper. And if they do, they can replace the shares that they owe at a cheaper price and therefore profit by the difference. So if you short shares of stock, this is what your risk graph will look like. So notice it's leaning out this way to the left, just the opposite of the long shares that we normally see going out this way. And so that shows that as the stock price falls, we end up with gains. But if the stock price rises, we end up out here in losses. But it's still a dollar for dollar, just a straight line up and down. Now, the big difference with a short sale is we have unlimited upside risk. And again, some people would argue that this is the most dangerous type of risk in the market, because there's no theoretical limit on how high a stock's price can rise. But there's another side of the argument that says, yeah, that might be true, but stocks usually fall faster and harder than they rise. So owning shares of stock isn't necessarily a whole lot safer. But yes, on paper, technically speaking, you do have potentially more risk with short shares of stock. So because of this, because you're borrowing shares and there's really no upper limit, you can't just pay for it in full because you're not buying anything, you're borrowing money. See, if you buy shares of stock at 100 and you pay 100 per share, well, you're fully covered. Worst thing that happens is the stock goes to zero and you're just out your money. There's no risk to the broker. But see, that's not true when you're shorting shares of stock. So the broker is going to charge what's called a margin requirement. And here's how it's going to work. So let's say that you want to short 100 shares of stock currently trading at $100. You have to post or front this money 50%, which is called the Reg T requirement, which is short for Regulation T. So it's just a stock market requirement, actually from the Federal Reserve, that says you must deposit 50%. Now, of course, the brokers, at least most of today's brokers, are not going to allow this unless the cash is already in the account. So when I say post, it just means that you have to have the money in the account. Now, in this case, you've shorted shares of stock for $100 a share, but then you had to come up with 50% of that on your own money. So the shares are worth $10,000. You had to post $5,000. So the accounting looks like this. The broker is going to say you have a credit balance of $15,000. And from that, we're going to subtract off the market value short, which right now is $100 a share times 100 shares or $10,000. And so that means your equity is $5,000. So at this stage, the entire equity is coming from your margin requirement. But watch what happens if all things go well and the stock price falls. The credit balance will, at least in the short run, remain reasonably steady. Your market value short, let's say, drops to 9,000, and look what happens to your equity. 15 minus 9 is 6. So notice what happened, that the stock dropped from 100 to 90, so that's a 10% fall. The market value short went from 10,000 to 9,000, but look what happened to your equity. It went up 20%. There's a 2-to-1 magnification, and that's because you only posted 50%. So you're going to have this 2-to-1 magnification effect. And yes, that means if the stock goes up, that you're going to lose at twice the rate. And this is one of the things that sets up the short squeeze. So for example, let's go back to the same setup, but now let's say that the stock goes up 10 bucks. So your market value short has gone from a value of 10,000 to now 11,000. Look what happens. 15 minus 11 is 4. So even though the stock only increased by 10%, your equity dropped by twice that, or by 20%. So you can see that when you have traders who are short and the market starts to rise, it's this leverage that's also creating some of the pressure. So when the short sellers start to see that market prices are really going on the rise, maybe they're breaking through a key level of resistance, moving averages, some type of a technical break, it can really send the short sellers scrambling, and partly for this reason, because of this leverage. So how much short interest is in a stock? Well, that's another good question, a related question. There's a number of ways to find it on the web, but one of the best is to go to finance.yahoo.com. So let's go over there real quick, and I'll show you how you can find out how many shares are short. So now we're into finance.yahoo.com. You can see the URL up here, and I've just typed in NVIDIA. And so you look down here and it says statistics. And if you click there, scroll down over here under share statistics, and right here are shares short. So there's 26.7 million, almost 27 million. It sounds like a lot, but we can also see that the percent of the float are just the actual shares that are out there available for purchase. And you can see that the shares outstanding will usually be much more. And that's because companies can hold what's called shelf registration. It's already been registered with the SEC, but it's not actually out there in the market yet. So the float you can actually think of as the actual number of shares available to buy and sell right now. So you can see it's just a little over 1%, not a lot. But the real key statistic to look at is right here, the short ratio. And what that is, it's 0.57. And what this means is that at the average daily volume, it would take about 0.57 days, or let's just call it about a half a day, to clear that out. So it's not really a lot of short shares. Now what's usually going to happen, let's say that this number was much bigger, like 10. Instead of seeing a lot of volume for 10 straight days, what's usually going to happen is you're going to have one day or a half a day of this massive volume of all of these short sellers jumping in to try to buy back these shares. So this is really the number to look for. And the bigger that number, because this is comparable, remember 27 million might be big, it might be small, we don't know. We can also see that a little over 1% might seem small, but if the volume is super small, the short ratio might actually be quite large. So this is the one number that allows you to make really fair comparisons among all stocks. So if you are trying to speculate that there's going to be a short squeeze, you'd love to see this number. The bigger the better. 3, 5, 10, 20, something like that. Almost all stocks are going to have short positions in them, but they're usually going to be short ratios of a half, 1, 2, something like that, fairly small. But when you get these short squeezes, this number is going to get really big. And now you can see the second part of the equation. These short sellers have all of this leverage, and they've got a ton of people that might be charging through to, these floodgates opening up to come in here and buy these shares back. And that's probably going to happen in just about a matter of a few hours. That's really what the short squeeze is about. We've got tons of people who are short that are all making a mad dash for the exits, trying to get out of these short positions. And that's what causes this great acceleration in the price. That's the short squeeze. So who's going to short shares? Well, it's always going to be a speculator, and speculators will short shares of stock that they think are either overvalued or pending negative news. That's usually when the speculators are going to jump in, like we saw with the banking stocks, a lot of the regional banks, Silicon Valley Bank, and they think, oh man, this thing's about to go under, and all of the short sellers come in. Now, at any given moment, you'll certainly have people that will just be shorting shares because they think that they're overvalued. But that's not usually going to be a massive short squeeze. But it's really when people are expecting potential negative news that you'll see lots of people piling in there. Now, when this happens, you will get, like all markets, you'll get contrarian investors. In this case, contrarian speculators who might end up buying the shares just because they have large short interests, saying, you know what, if this thing turns out to be a short squeeze, it's going to go through the roof. But both sides are highly speculating because short positions can continue to drive prices lower long before they get the short squeeze. So it's just a big game of chicken, who's going to outlast who. But once the stock price starts to break up, you can be sure that there's going to be a mad rush to try to buy back these shares. So I mentioned GameStop earlier in the presentation. Let's jump over to a chart and take a look at that massive short squeeze. Okay, so now we're into the TradingView platform. So you can see over here at the end of 2021, the stock was just flatlined at about $5 a share. And then there was the meme stock. There were a lot of the Wall Street Bets crowd that were trying to push it up, but there was also because there was a lot of short sellers in there. People were just shorting this thing coming out of COVID because of all of the negative news. So what happened is that once it started to have this price increase, the short sellers all made a mad dash for the exits. And look at that. I mean, it went up to like 120 in a matter of just 3, 4, 5 candles or so. I mean, just an absolutely mad rush for the exits. This is a classic short squeeze. Now, the problem with a short squeeze, as you can see, they also come back down to earth quickly. And this is another reason you have to be very careful about playing them, and also why options are almost the only tool to use. Because you could roll up through this as this is happening, or sell half and roll half, or continue to do that. Buy 20 contracts, sell half, roll half, then sell 5 contracts, and then roll half, and kind of just stay on it. At least you can get your principal back, because you just never know when this is going to come back down, crashing to earth. But this was a very, very classic short squeeze, and now you have a better understanding why they happen. All right, so now that we've covered the basics of a short squeeze, what they are, why they happen, what's the best way to play it? Well, the first thing is always remember it is speculative. It's highly speculative. Just because you see a stock with a large short interest ratio doesn't mean it's a layup to go play the short squeeze. It's also going to be very short term. The problem is you just don't know when it's going to occur. Now, because of this, most of the time you would want to use out of the money calls. And part of the reason is that as this is happening, you're not going to be the only person seeing this, and you might start to see upward pressure on call prices. And if that happens, you might actually see volatility rise. Most of the time we see volatility rise when stock prices fall, but just like with the case of GameStop, the volatility went to something like 650%, just literally off the charts. And that was as prices were rising. So just remember what volatility is. It's just the price that people are willing to pay for the right to walk away. It's what they're paying for the true option, not the cost of carry, but the actual right to walk away. So when they get into something like a short squeeze, the right to walk away becomes incredibly valuable. So because of this can be an added benefit if this volatility spikes as well. And another reason that it's a big benefit is this concept of normalized vega, which I've talked about before. in other videos. If you don't know what that is, you can certainly search for it in my channel, and you'll see what normalized vega is and why it's such a big benefit if volatility is rising for out-of-the-money options. So that's going to be your first play most of the time. However, if you get in a little late, which is probably going to be the case, otherwise it's assuming that you know something that the market doesn't. Most of the time when traders are hopping on this, they're saying, hey, look at GameStop. It went from 5 to 10 to 15 to 20. I'll bet it's going to get higher. And then they jump in, but yeah, you're jumping in at very high implied volatilities. And so if that happens, you would probably want to use an out-of-the-money vertical spread. You could also use diagonals, but I would probably stick with vertical spreads if the volatility is truly high. The reason I would, without going into more discussions as a general rule, use the out-of-the-money verticals is that if the short strike becomes at the money, then the vertical holds lots of extrinsic value, and you might not really be able to sell it for much more than the price you paid, unless you're willing to hold it close to expiration. So see, now it sets up a dilemma. If you say, let me buy a 5-day vertical spread so that it's going to be pretty close to expiration, well, then you'd better hope that the short squeeze happens in 5 days. And that's just probably not going to happen. If you think it's going to be sometime in the next 30 days or the next 60 days, and you buy a longer dated option, but it starts now, the short squeeze, you might end up still paying a lot for the vertical because you'll now find that that short option is now holding most of the extrinsic value. And that's going to depress the price of that vertical spread. So it does become tricky. So if you think you're getting on a kind of the early side of a short squeeze, I would stick with the out-of-the-money call options, but make sure you understand your hedges, rolls, and morphs. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z's Facebook trading group, where you can find all of the archive videos from our trading forum. And you can find a link in the description below.